Hello and welcome to Big Deal. I'm Nisha Poddar. Now, a big trending topic that we are seeing is the secondary exits by the venture capital funds. Now, this is seeing a lot of traction at the present moment, also because of the dwindling valuations that we are seeing in the startup world, and also because of lack of liquidity. So therefore, the secondary exits by venture capital funds is in vogue at the moment and is seeing a lot of traction currently. And also remember that these venture capital funds are going in for secondary exits because of a lack of other options being available, and also on the other hand it is done at a significant discount. Let me welcome on the show the three experts who are going to throw more light on this particular discussion. Let me welcome to CNBC-TV18 Ashish Fafadia of Blume Ventures, Pankaj Naik from Avendus Capital, and Anand Lunia of India Quotient. Hello and welcome to all of you. Anand, starting with you. Overall, how is the exit mechanism and the scenario looking for the VC community right now?
Well, Nisha, some of the recent IPOs have actually opened up a path, right? I think it's looking good. People like Pankaj are very helpful. They are clearing the market. And I think this is the first time, you must have seen the news that for a change, a lot of capital, both from private equity and venture capital, went back out of India. Very positive sign. And things are looking quite positive. I wouldn't say that we're making a lot of money, but yes, there is a lot of liquidity in the market right now.
So Anand, that's a good sign. Let me take across to Pankaj, who's the deal maker here. Pankaj, I'm sure you're busy with secondary exits at the moment. Give us a sense on what are the top trends in the secondary exits for VCs when it comes to the startups.
Yeah, and thank you, Nisha. Thanks for having me here. As Anand rightly said, I think most of the banker community is busy in different products. Obviously, capital markets are good, so a lot of companies are preparing for IPO and the block trades are happening. Second is obviously the private secondaries, and that in last 4 or 5 years, probably $7.7 billion actually gone through the private secondaries, which is actually almost as big or bigger than actually the IPO and block trades, especially in the tech sector, right? So, and the third, actually, obviously the M&As have been far and few, especially cash M&As have been far and few. The new trend that we are observing, and we are in the middle of it, is actually the portfolio secondaries. So there are two ways venture capitalists are, taking exits in the companies. Either private secondaries, which are being facilitated by the founder-run secondary process, which we have been doing for last 4 or 5 years and almost given $4 billion exits through that. And the new trend is also doing a portfolio secondaries. So these are large secondary only funds that are now focused on doing a complete buyout of the GP portfolios, and that capital is actually being raised worldwide quite significantly. And India earlier was a little shallow market for that, especially within tech. But now, considering the maturity of the companies, this particular trend of private secondary portfolio being bought by institutional secondary investor is significantly on the rise. Similarly, the high net worth individual market is also looking at the purchase of the high quality portfolio of venture capitalists. Obviously, the size there is smaller as compared to the institutional secondaries, but both these markets are very active apart from the IPO and secondary exit market.
All right. So that's a definition of where the secondary exits are. But Ashish, jump into this discussion. How are secondary exits very different from the traditional exits? And also, I see that a lot of secondary funds would like a huge, significant discount to the last round as well.
Sure. So, first of all, thanks for having me over. We'll break this down into the two types of secondaries that we are talking for this discussion. The first is where you are selling your secondary stake to an incoming investor. We'll focus on the second one, where the fund managers are being approached by other larger investors who are saying that we can piece together a portfolio out. You have had a maturity of your fund. You might need to exit over the next 1, 2, or 3 years. Why don't we pick a certain assets from your portfolio and buy them out and take it forward? So in this secondary kind of a buyout, people try and operate with two models. One is where they take those over out and out, and then the investors have changed hands and the journey for the company goes on. The best opportunity for these come in markets where private equity and VC investors have completed a couple of cycles, so that there is a visibility and depth that eventually these are more like bridge secondaries, where the company has another 2, 3, 4 years to get to an IPO and the VCs have to get out. And the discount comes into play for this because the VCs or Ps have to get out, and there is a time stamp at the end of the fund life, which is what the secondary investors would come in and say, okay, I'll buy this out so that there is some kind of a liquidity for your investors. The other category is where the investors who are buying this out say that, guys, you have had a run with the company, you understand the company inside out, you understand the DNA of the founder. We are giving the liquidity. You can clean out your other LPs and give them consideration for these assets, but manage these companies for us, for which there will be extension effectively of your journey. Both of these arrangements are starting to become common because Indian markets have reached that stage of maturity on the private alternatives asset side where this becomes plausible. Hitherto, you saw a lot of Singapore, Hong Kong, Canadian and American investors do these things and come in. Now it is starting to get common in India as well.
That's right. It's a newer phenomena in India, though has been happening, but right now the trend is very strong. So buying out portfolio from either the VCs or the VCs stay and the LPs are given an exit and new LPs come in. By definition, these are the two mechanisms clearly that are working out. But Anand, in terms of the texture of the transactions being done, give me a sense of what are these buyers really looking at?
Well, they're looking for the winners. Nisha, bulk of the investment in India started from the first check that Tiger put in Flipkart, right? And I think it's been like 10 to 14 years since then.
Yes.
And I think between 10 to 14, 15, Pankaj used to focus a lot on fundraising, and a lot of money came into India. And I think many of those companies, including Flipkart, including Zomato, Swiggy IPO now, Bluestone, most of the companies which sort of were in that era, 2010 to 15, they are now ready either to exit or, of course, many have already given up and wound down. Buyers are looking for winners. This is the time where buyers are saying, I'm happy to pay a premium. I want a category winner. I want your best company and somebody who's sort of, can expect to be on the path of what Zomato has done after listing. Right? That's the expectation. Usually, when you say secondary, it's the image that you come with. Okay, you're trying to clean up the house, and you're selling assets at cheap, and you're sort of cleaning and bottom fishing. That's not at all the perspective. This is not a scavenger's market. People are looking for really the outperformers, right? Particularly the outperformers who survived the boom and bust in 21.
Right. So they are looking for outperformers. So if all the juice from your portfolio is really taken away by some of these secondary, funds and buyers at this particular time who are looking for value picking and are also cherry picking. Ashish, Fafadia, what is left of your portfolio, and in terms of your own MTM gains, as well as what happens to the remaining part of the portfolio, what happens to the exit plan on those?
Sure. So I think a better perspective, having done 2 of these exercises over the last 4 years, and we pretty much, I think, if I can look back, we were the first amongst the people in India who attempted something like this, and we did it in partnership with Pankaj's team as well. So the attempt here is, yes, the cherries are going to be picked at the top, but these are also eventually the big drivers. The fund is coming to an end anyway. So you have to put them out and sell. The opportunity here is that you are going to have somebody come in, provide the liquidity, and not wait it out till the optimum IPO time. And then there is going to be some other companies that you have a better shot at. So it's not that there'll only be 2, 3, 4 good assets in the fund out of a 25, 30 or a 40 company portfolio that a VC will have. There will be about 20% of them which will be companies that will do well. The second is going to be an attempt which will clean out the top 3, 4 which are matured at that point in time. And then you, over the next 2, 3 years, you go back and work on the remainder of the companies and take them out. And you also get a realistic shot at going back to your LPs and say, look, with the top 3, 4 companies or 5 companies, I have delivered 2x of the DPI. Now allow me an extension. Those conversations become very plausible, which otherwise people will doubt and say, you have no DPI, you're struggling. Is your MOIC legit? Show us some conversion. So it is a win-win, is what I would say. To the extent you're not deep discounting, it acts as a win-win construct.
Right. So giving returns to the LPs and also for future fundraising mechanism, these exits are very critical. Now, Pankaj, you have seen many such transactions. Give us a sense on the kind of valuation drop that one is seeing. Also, how does it work out between the real value as well as the last fundraise value? Because very few companies can really command the kind of valuation that they achieved in their last round of fundraising when there was high liquidity and euphoria in the market. And third, then what is the buyer, or are there new kinds of buyers also emerging? Give us a lay of the land when it comes to this kind of a deal structuring.
Sure, Nisha, I think all very, very valid questions, and especially on the valuation, right? So 2 things. One is, what was the last round valuation and when the last round valuation took place? Ideally, if it's 2021, a lot of people are thinking whether it was, highly valued or not. But more importantly, they also look at the NAVs, right? So what is the fund carrying their particular investment at what kind of NAV? And if the fund has been, prudent enough to kind of, you do a mark to market based on comparables, either here in the US, if it's a SaaS company, then look at the US. But here you look at the public comparables, etc. And they're marking their NAV at a justifiable price, then the discounts are not very high. For actually some of the star performance, as Anand said, right, in continuation funds where, GP continues and LP just changes, the discounts, even I've heard closer to 0% or even less than 5%, if your NAV is well justified. However, if in your portfolio, when you actually report your NAV, if it's still at, the sky high valuation where the comparables for those companies have reduced significantly, then the secondary investors ask anywhere between 20% to 35% discount on those NAVs. Also, because a lot of these investors, this comes to your second question, these are fund of funds, they're pure secondary funds. They also are LPs in a lot of GPs. So a lot of times these investors actually have some reasonable sense on what actually the real value of some of these portfolio and their what real NAV is. So even if you are trying to tell them that my NAV is X, in their mind they know that's probably already 0.8X, and then for a liquidity discount they'll probably give at like 0.7, 0.65, 0.75, etc. Ultimately, it's also demand supply. For example, a particular asset has a more number of sellers, and if there are 4 funds are going out there in all their portfolio, asset is coming again and again, obviously that particular asset will see more, NAV discount to NAV vis-a-vis something which is an asset that everybody wants to go after. That obviously, and if it's a less in supply, then obviously discount is less. These are the, I think, broad ways that people are looking at. And third, the most important thing is also, especially in the continuation fund, all these secondary investors are very focused on the pedigree and reputation of the GP. So if they want to continue with you, then they want you to be honest, and that's why they want you to record and report your NAV reasonably straightforward manner. And if your track record of returning capital also is important.
Right, very, very important Pankaj. And of course, it stands out that this kind of transaction, in terms of valuations at this point, is difficult. How do you come to the right valuation as the market has considerably changed? But on the other hand, there is relationship and reputation-oriented due diligence on the fund manager and besides the company as well. But one big takeaway from all that you've shared on the secondary exits is that these are the value pickers and buyers right now who are going to face the next wave of IPO exits or M&A exits in the startup world. So we'll slip into a short breather and we'll talk more about the other exit options and how's the scenario looking for the venture capitalists right after this short break on Big Deal. Stay tuned. Welcome back. You're watching Big Deal and we are discussing the various exit options for the venture capitalists. Let me begin with Pankaj on one important aspect. How do you see the IPO market for the startups at the current moment? Because there has been a pipeline being built, but of course, investor appetite is key over here, and the valuation expectation from the founder is another very important aspect and one of the eligibility criteria for the IPO to happen. And now, of course, SEBI's requirement of key performance indicators and the confusion around that. Putting all that together, the IPO market still looks like it's still struggling for the startup world.
So again, I think if you just look at the overall IPO market, obviously it's going great. Whether all the companies, whether it's consumer, industrial, financial services, in general, there's a lot of liquidity and investors want to put money. Having said that, I think a lot of technology companies are still on their way to go public, and not all of them are in the best in terms of preparedness to go public. Having said that, most of them are working towards going public in next couple of years. So my sense is even the 2024, you wouldn't see a lot of companies hitting the market. 2025, especially later part of 2025, you will see many tech companies going to the public market because they are working very hard on the whole presentation of KPIs, how they track their business, how they can actually be answerable to the investors, and how on consistent ongoing basis how they will track it. That is one. Second is last 1 or 2 years people have been focused on profitability and reasonable growth. So their businesses are very much are falling in place with respect to being ready to go public. And the third and the good thing about it is that most of the tech companies that had gone public and that saw volatility in their price actually have come back reasonably well, both on the business as well as on their price. So that is giving a lot of comfort to the investors to look forward to invest into newer companies. And the companies are also being encouraged to actually prepare to go towards public market. And there are a lot of new business models, especially on the SaaS side or fintech SaaS side, which have not been, have been seen by the Indian public market. I think some of those excellent companies are also preparing to go public. And I'm very excited that the next year would see some of these great companies approaching public markets. So I'm quite excited actually.
All right. So the IPO, pipeline is actually strong from the startup world. It just depends on the market acceptance as well as the market momentum of these companies to be taken for the listing. Now, Anand, when we talk about the various exit mechanisms, strategic buyouts have been one of the cornerstones for private equity exit in the past. Now, that is the one which gives the significant return to the erstwhile investor as well, and is considered to be a good exit. Where do we stand when it comes to M&A in the startup world, and especially from the bigger strategics now that we are in an omni-channel world? So is that a possibility, and how are the trends there?
So Nisha, in the strategics, we have rarely seen global strategics do any deals in India, right? I mean, very few deals, particularly like Flipkart, Walmart happened. But those deals will be very far and few. The second category of potential buyers and strategics would be Indian conglomerates. They don't want to buy juice from the market, like you said. They'd rather have their own mixer grinder and juicer at home, and it's make versus buy. If at all the conglomerates have bought anything, it's more like bottom fishing or buying buying only for sort of some skill, not necessarily buying revenue or buying leadership. The third category, which I'm hoping will emerge, is as some of the startups we spoke about, as they go on to public markets, they become liquid with their stock. I'm hoping that those will drive some of the M&A. So, for example, Zomato buying Blinkit was one of those kind of deals. And I'd say the only expectation or hope that we have in this market would be from listed startups, larger startups buying smaller startups. I think that is the most likely scenario.
Yes.
The other two categories, the global buyers or Indian conglomerates, of course, Tatas have done a few good deals like Big Basket, etc., and Cure Foods, Cure Fit. But I think besides that, we'll probably see one or two deals every 2 years, but that's about it. We're not expecting much there.
So big strategics and conglomerates are the biggest value pickers, Anand. And you have the startups have to come with something that is so unique that they can't build. So that's another catch here. Now, Ashish, final word to you. Is there a problem in founders merging with each other? Why has consolidation not taken place in the startup world, even if it went through different difficult cycles for the last few years?
So there is no problem in that happening. The only condition is that when two heavily or overvalued companies are going to get subsumed as one, or one heavy overpriced company acquires another company and attributes a overprice onto it, it doesn't help anybody's cause. Cap tables were well funded. It is the first time in the ecosystem that we have had a phase of about 24 to 30 months of stress where funding rounds have not happened. So you might see a little bit of it because until now, investors had the dry powder to go out there and say, we have the winner on our cap, we are on the winner's cap table, let's keep it on. So that is what will push out the outcome. With valuations taking a hit, with liquidity drying up, a lot of those options also will emerge. But at the end of the day, the profitability is going to be the key factor, and the ability of the companies to run profitable and show a site of listing, which is ultimate holy grail. No other mode of exit is really viable because you can't get 70% of the cap table exited by way of a buyout. Or someday somebody has to go and tap the public markets.
Yes.
To that extent, we do feel listing a little earlier than later is the way it should go. We don't need to wait for companies to get 20,000 crores of market cap. It's fine to hit them at 4,000-5,000 crores and let them grow at 25-30% CAGR. Enough companies have done that. So why not?
All right. So IPO market is one of the holy grail for most of the startups and the investors eyeing out for that. And I would like to re-emphasize that the current, secondary exits are also happening, and the new value buyers who are coming in are also eyeing that IPO market for further monetization or exit opportunities. Thank you so much, Anand, Ashish, as well as Pankaj, for joining in and giving us more details and very candid views on how the exit mechanism is looking for the VC world. Thanks so much for joining us, to all our viewers as well.